Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. Kelvin here again. Very good morning. Today will be Tuesday, the 4th of June, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. Right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term intraday technical outlook on the major stock indices, the major dollar pair, and two key commodities, that is, i.e. the gold, XAU/USD, and West Texas crude oil, let's have a recap of what has taken shape yesterday in terms of the release of the respective economic data, as well as events or particular news flow and their impact on the movement on the cross assets. All right, so let's start with the news release first in terms of the data. So yesterday we do have an key data release, which is the ISM manufacturing PMI data release from US. So let me pull up my screen so that you guys could actually have a good look at it. All right, so over here yesterday, Monday, during the US session, there's the release of this ISM manufacturing PMI data. So even though the manufacturing sector is not a significant weightage in the US economy, as we know that 2/3 of US growth is driven by the services sector, but nevertheless, it do have a particular reflexive loop effect on the cross asset classes, that means i.e. sentiment impact. So the ISM manufacturing PMI continues to be in a contractionary mode. That means anything that's below 50 is contraction, and market is actually expecting only a slight improvement from 49.2 in April to 49.6, but it actually contract much further to 48.7. So if you look at the trend, all right, it's slowly inching downwards since the March high of 50.3, and the 5-year trend is slowly also decelerating as well. So what you could see over here is right now we have 2 consecutive months of contractionary reading, which is negative in terms of economic growth in the US, was given the fact that manufacturing PMI is a leading economic indicator, but to me, if you look at it from a fundamental, hardcore fundamental perspective, I got to look at the services number as well to get a better gauge. That means the services PMI, which is going to be released, I think it's not next week rather than this week. The services PMI data, in fact, it's on Friday. Later I'll do a quick check on the calendar again. So the services PMI, ISM services PMI data, to give me a better gauge of the overall US economic condition, was given the fact that the manufacturing activities in US only form a small percentage, right? So, but what's encouraging over here is the input component. Because you see the manufacturing PMI, ISM manufacturing PMI, there's a lot of component inside, and one of the other components is called prices paid, because as indirectly as an input cost for US manufacturer. All right, so if this prices paid sub component actually showing a slight inch down from 60.9 to 57. Market is expecting only 60, all right? So what it means that input prices on the high side previously that was seen in the last start of the year, okay, it slowly accelerate on the start of the year as it starts to cool down. It's much softer than what its market is expecting. So if you look at the trend, all right, it's been accelerating since the start of the year, and right now it starts to cool down a slight bit. So that's a pretty sign of an encouraging. Why? Because that actually reduced the odds of stagflationary risk in US, which means, i.e., higher chance for now of the US Federal Reserve to ignite the first interest rate cut in September. So later I'll share with you the pricing of the US Federal Reserve Fed cut expectation as being priced in by the CME Fed Watch tool based on the Fed Funds Futures market, and also using oil prices as a gauge as well. All right, so that is the key economic data released yesterday. So given the fact that of this rather weaker than expected ISM manufacturing from the US and the lower risk of a stagflation risk environment because of the manufacturing prices paid, one of the subcomponent inside the ISM manufacturing PMI starts to inch slightly lower than expected. So that actually created a positive feedback loop into the market. We start to see dollar strength selling off. All right, so what we could see over here is that the dollar index actually went down yesterday and closed below the key support that we highlight earlier in the last 4 weeks or so at 104.20, and also went down below the 200-day moving average dollar index. All right, so given the fact that it went down below the dollar index 200 average, and if today it starts to actually maintain this momentum by not surpassing back the 200-day moving average and go back into the ascending channel over here, because the broke down this ascending channel, so very likelihood the dollar going forward, longer term perspective, the dollar may start to actually inch much lower over here with the next support coming in at this region. Okay, but that's for more of a multi-week to multi-month perspective, because this is a daily chart over here. Okay, at this 102.70, 102.20 level, okay, using the dollar index as a gauge of the dollar strength or broad-based dollar strength or weakness. All right, that means overall what you could see over here is that is going to evolve in this sideways configuration, major sideways configuration since the low of last year July. Okay, it's inside this sideways range configuration, come break above the major range top of 107. All right, so now this dollar strength weakness yesterday also was driven by the pullback in the further pullback in the US Treasury yield below the 4.5% level. Okay, it reintegrated back below 4.5% and starts to give up almost last week push up over here, and now it's also testing the key support level at 4.32%. It hasn't broke yet below the 200-day moving average, but the dollar index broke ahead of it. So something to pay attention to. Why? Because if you see a further push down in the US 10-year Treasury yield, i.e. it means that lower cost of funding, given the fact that the US 10-year Treasury yield is being used as a global risk-free rate to price corporate loans, to price long-term, even consumer loans. So if we start to see this risk-free rate, benchmark risk-free rate, long-term benchmark risk-free rates starts to inch down much lower, it implies lower cost of funding globally, which actually drive risk-on behavior. Why? Because corporates and consumer will be able to actually have lower debt servicing costs, as for corporates, higher profit margin, for consumer, higher spending power. Okay, so net is a positive risk on environment. So this is the intermarket correlation. All right, so now impact on the cross asset classes based on this key movement yesterday was the US stock market managed to actually, as usual, do that bullish reversal only in the second half of the US session. So at the start of the US session, still recall at 10 p.m. Singapore time, that was the release of the ISM manufacturing PMI data, but prices starts to pull back first, but that came within our expectation because of the technical factor. Because those who follow our day dose of market insight yesterday, I do share with you the intraday outlook on the major US stock indices, the Dow Jones as well as the Nasdaq 100. They actually reached short-term overbought level due to a sharp rally in last Friday's session. So this pullback at the earlier start of the day of the US session doesn't come as a big surprise to us. All right. So that after that overbought short-term intraday overbought condition from last Friday is being worked out, the market continued to follow the positive macro factor. That means weaker dollar strength weaker, softer US 10-year Treasury yield, and it starts to do that bullish reversal again in the second half of the US session. All right, strong rally and almost close near the opening level for the S&P 500. The top performer was the Nasdaq 100. That is up a positive 0.5%, also a short rally. The Dow Jones actually underperformed, but it did reverse, but it's still close in a bit at negative 0.3%. But most importantly, all of them shaped that bullish reversal, keeping intact that short-term bullish tone on the major US stock indices. And like I shared with you all, what causes the outperformance on the Nasdaq 100 yesterday that gave a gain of 0.35% is due to AI optimism again. All right, so what we could see over here is that we see a very strong rally in Nvidia, positive 4.9%. so this is all being supported by the news flow that I shared yesterday, where Nvidia going forward, starting from next year, every year they will do a upgrade on their chip to actually improve AI capability. That means, i.e., if corporation wants to have a cutting edge AI business model, they got to get Nvidia chip, because they claim that they are actually the best in the world right now to actually drive AI research and AI capabilities, hopefully to actually improve productivity for corporations. Okay, so they're trying to use that Apple playbook, where Apple, the flagship product so far in the last 20 years has been iPhone. So iPhone every 1 year or 2 years from then they will actually do an iPhone upgrade. All right, so instead of targeting the consumer, Nvidia is now targeting on the corporation. In order to see productivity, you need to have AI. So how to get AI? You need to have AI chips to run your AI business model. This is where Nvidia is providing these services and products. So that should explain the positive outperformance of Nvidia yesterday, which is very important. Why? Because Nvidia is the third biggest weightage component stock right now in Nasdaq 100 as well as the S&P 500. And for sure, the energy stocks actually underperform inside the S&P 500 due to the weaker oil price. Yesterday we highlighted due to the fact that if the 70 level breaks on the downside for West Texas crude oil, we may start to see a further plunge because of that not favorable fundamental news flow coming out for OPEC Plus, which actually kind of disappoint the market in terms of their voluntary cut component, where they decided to actually make it expired in Q3 2024 rather than extending it towards the end of this year. Okay, so that should explain the weakness in the energy stocks. All right, so also another positive news flow coming out from Nvidia was this: they actually benefited from the higher interest rate environment in US due to parking their excess fund in money market. So Nvidia leads company minting money from interest earned from cash surges. That means what it means that over here they actually invest their surplus cash from their revenue in money market like treasury securities and certificate of deposits, and this was their interest. This was their interest earner. So I could see that this orange line over here is the interest income that they are parked their excess cash with. And you look at since Q1 last year, there's a huge growth of positive curvature on the upside. That means right now they have actually total interest income earned as being projected all the way up to Q1 2025, depending on, because it's fixed income. They actually project 359 million of interest income earned from depositing into such money market funds, able to cover their interest expense from their debt at 64. So that also explained to us that Nvidia itself and other is actually a company that do have a surplus cash holding, and it could cover their ongoing debt servicing costs. That means, yes, even though there's a growth company, but it's not your traditional growth company like the Russell 2000, where they have high debt servicing costs due to a low cash flow. Whereas Nvidia has a tremendous amount of cash inflow supported by interest income earned from money market funds that could cover substantially on their interest expense from their debt. Okay, so that also explained to us yesterday's sterling outperformance of the NVIDIA that is supported by this positive news flow. Right. So yes, that is the news flow that could impact on the various cost asset classes. So what we could see over here is one more thing to share is the spot go. So spot go XAU/USD. Yesterday we do highlight a key support level to watch. Yesterday we turned neutral because of a mixed element in our short-term intraday technical outlook. So the lower limit of the neutrality range was 2,320. So spot go managed XAU/USD managed to bounce at the 2,320 level. Also supported by the weak softness in the US 10-year Treasury yield that went below the 4.5% level mark. All right. So why? Because a lower US 10-year Treasury yield lower the opportunity cost of holding gold, which is a non-interest income bearing asset if you hold gold doesn't give you dividend or interest income. All right. Then yes, the worst West Texas oil was yesterday going to plummet after the break of that 76.70 level. So West Texas oil, if you look at the price of the West Texas oil after the breakdown of that 76.60 level, the key support level, medium-term support, it broke down. So yesterday it actually continued to see 1, 2, 3, 4 consecutive day of decline. Yesterday decline was the worst at 4.2%, and this daily bloodbath yesterday was the worst daily performance since November 2023. All right, a rather weak negative sentiment after OPEC Plus meeting, okay, on Sunday. Okay, so this is the news flow and their impact on the various asset classes. Now let us share with you some intermarket correlationship. All right, so we know that oil prices itself do have an impact on inflationary expectation. Why? Put in a way that oil prices impact everything. Okay, it indirectly impact the energy costs like your fuel cost for your car, your fuel cost. Then eventually it will impact the food prices as well. Okay, because to operate a food chain, you also kind of need energy, right? All right. So with lower oil price, lower energy costs, potentially food prices could be lowered because the businesses may not want to actually hike food prices to cover future energy costs, which could be lower. So that could also imply lower inflationary expectation. So how do we express that graphically? Is by looking at this chart over here. Okay, so what some of you all have followed my data of market side. Occasionally, I do flash this key intermarket dynamic chart by plotting the Fed funds rate together with the break-even rate, the 10-year Treasury yield, the 5-year break-even inflation, and the 10-year break-even inflation US. So this break-even inflation, think of it as inflationary expectation as being dictated by transacted financial market instrument taken from the US 5-year Treasury inflation protected security, tips in short. All right, so and also WTI crude oil. So if you look at WTI crude oil price move hand in hand, synchronized since 2020. That means they move in direct synchronization with the 10-year break-even inflation and the 5-year break-even inflation. That means if oil prices going to tumble, that means WTI price is going to tumble. The break-even inflation from a 5-year horizon, medium term, and a longer term 10-year break-even horizon also starts to inch down lower as well. So if inflation expectation starts to inch down lower, it will also translate to a softness in the US 10-year Treasury yield. Notice that the US 10-year Treasury yield also moved in line closely with the 10-year break-even inflation. All right, so you look at the break inflation starts to turn down yesterday, the US 10-year Treasury yield also going to inch downwards. That means what it means that if this continues its path on the downside, that means if oil price going to tumble further on the downside, the US 10-year break-even both on the 5-year and 10-year also starts to move downwards, implying softer inflationary expectation. So if that is the case, the US Federal Reserve officials or the Fed may find more evidence to support their interest rate cut cycle, okay, rather than hike, okay, in their next step of things. So that actually explained to us based on the CME Fed Watch 2, based on what we see so far in the market's dynamic, inflation expectation, lower oil prices, weaker ISM manufacturing PMI data, ISM manufacturing paid component within the manufacturing PMI data slow down at a slower bit. That actually increases the odds of another interest rate cut before 2024 ends by looking at this table here. So the current Fed fund rate is 5.25% to 5.5%. So market is not expecting, based on the CME Fed Watch 2 as implied by the Fed funds futures market, no change for the June meeting next week and as well as the July meeting, 99%, 83%. But the first rate cut will still come in as implied by the Fed funds futures market at a high probability of 68.4% to bring down to a 25 basis point cut. How do we know that? Because by taking this 5.25 minus this, right? So it's 25, and implied 25 basis point cut by a higher probability in the September meeting. And November meeting, after that, stand pat, because it's 99% chance, only 0.06%, less than 1% chance of a cut of another 25 basis point cut to break down to 4.7% to 5%. And we start to see an increase of odds, right, to 50, above 50, now at 58.5% for another cut to come in the 18th of December FOMC meeting. So based on the current pricing as calculated by the CME Fed Watch 2, taken from the US Fed Funds futures market, is now implying to us there is a high odds of 2 interest rate cut before 2024 ends, based on the current dynamics that I explained to you all that's taking shape in the markets. First cut in September, then followed by December, right after the US presidential election in November, right? So that actually also explained to us why the bullish reversal in the US stock market still remains intact. Okay, so this is the key fundamentals and intermarket dynamics that I share with you all for today. Right, now with that, let us now straight away jump straight to the short-term intraday technical outlook on the various cross asset classes. Still recall yesterday, we will still have that short-term intraday bearish bias for the dollar weakness story to play out. Okay, so let us start with the euro dollar first on the FX market. Okay, euro dollar. Okay, let me expand my screen so that you guys could see. Okay, so for the euro dollar, that means euro push up, that means dollar weakness. So for the euro dollar, yesterday we do have that short-term intraday bullish bias. It's really clear up above the 2 resistance level that we highlighted, 1.088 and 1.0925, 0940. As we know that on an intraday basis, price actually oscillate, they don't move in one straight vertical line. And with the RSI now back at the overbought region again, and with it hitting close to the resistance level, potentially there could be a chance of a pullback coming into play. All right, so if we take into account, this could be in terms of elliott wave perspective, there could be the wave 1 and the wave 2, and that is the wave 3. Okay, if you do at the Fibo extension level, okay, 1.618. So there could be a wave 4 intraday correction to actually negate this current overbought condition that is being seen on the hourly RSI. So this is how I look at things from a short-term intraday technical perspective, slightly different from a longer-term fundamental and the longer-term intermarket dynamics that I shared with you earlier on at the start of the daily dose. All right, so potentially, right, as long as this 1.0925/1.0940 short-term pivotal resistance zone that I'll be using for today, there could be a chance of a short-term intraday pullback in the euro dollar. So with that, for today, we'll be shifting to a short-term intraday bearish bias for this potential pullback to come out, to potentially pay out, to work out its overbought condition as been seen on the hourly RSI. Support level to watch on this pullback. First support, 1.088 level. For sure, this is a very clear graphical support. Previous range stop, that is the pullback support level. A breakdown below it exposes 1.0860 / 1.0840, which is also confluence with the upward sloping 20-day moving average. And in terms of the Fibo retracement, if you retrace this swift move up yesterday, these two support actually confluence with key ratios, Fibo ratio as well. The 1.0880 confluence with the 38% Fibo retracement. The upper limit of that 1.0860 confluence with the golden ratio of 61.8%. Okay, only an hourly close above 1.0940 short-term pivotal resistance will invalidate this potential intraday bearish pullback scenario to see the continuation of that bullish move to expose the next near-term resistance at 1.0950, 1.0970. So what's this level? Fibo extension level, and as well as the range swing high area of 8th of May and 8th of March and 14th of March this year. Okay, so that's for the euro dollar. Very similar movement on the sterling pound as well, which is the cable hitting the 1.28 figure level that we highlighted yesterday, and also close to this graphical descending trend line that I drew from the high of 14th of July last year. Okay, very close to this level. Okay, over here as well. So with that, right, we'll be actually seeing the risk of a potential pullback as well. Okay, over here, given the fact that this could be a kind of a wave 3 as well, 1, 2, 3, based on the Fibo retracement taken from here, I'll push it down to here, almost 2 times. Stay high, so there could be also a chance of a minor corrective wave 4 pullback. All right, so with that, we'll be flipping to a short-term intraday bearish bias for this potential minor corrective pullback to unfold, as long as 1.2860 short-term pivotal resistance is not surpassed to the upside for today. First support level to watch, 1.2760, followed by 1.27 figure level, which was yesterday's key short-term pivotal support level that we highlighted to maintain our bullish bias yesterday. A very nice test at 127 before that short rally take place. All right, so these two support level are for the potential minor corrective pullback scenario that could unfold today on an intraday basis. However, a breakout above 1.2860 short-term pivotal resistance level, that means the hourly close above it, will invalidate this potential intraday bearish minor corrective pullback scenario to see the continuation of that that bullish bias to expose the next resistance level on the sterling dollar at 129.40, followed by 130 figure level. So that's for the sterling dollar. Asia Pacific currency, let us start with the dollar yen first. So dollar yen, yesterday we do have that bearish bias, also in line with the push up in the euro dollar and the sterling dollar. It hit the support level that we highlighted. Actually, we highlighted two support level, 15660, 15590. Hit 15590 and stage a bounce. All right, so and as well as now going back up above the 20-day moving average and reintegrate back above the minor ascending trend line that I drew from the low of 3rd of May. And what's interesting over here, after hitting that 15590 level, the RSI starts to shape a bearish divergence, okay, right at the oversold region. So with that, potentially there could be an intraday bounce as well coming into play with the dollar yen, in line with the pullback of the euro dollar and the sterling dollar. For sure, using 15590 as a key short-term pivotal support for today, we'll be flipping to a short-term intraday bullish bias for that potential minor bounce to unfold. Bounce resistance 157.50 level, which is yesterday's high. A break above it potentially sees 158 figure / 158.30 level. That was yesterday's short-term pivotal resistance. Only an hourly close below 155.90 will invalidate this short-term intraday bullish bias for that minor bounce rebound scenario to see the continuation of that bearish bias unfolding to expose the next near-term support area at 154.60, which confluence with the 50-day moving average. A break below it retests the 16th of May swing low area at 153.70. So that's for the dollar yen. Aussie dollar also push up higher as expected and hit the resistance, almost hit the resistance level at 67.10, and with the price action now showing a bearish divergence on the hourly RSI. So with that, we'll be flipping to a short-term intraday bearish bias as well on the Aussie dollar, in line with the Euro dollar and the sterling dollar for today. Today only, the intraday basis. So flipping to a short-term intraday bearish bias for a potential minor corrective pullback to unfold in the Aussie dollar as long as 67.10 short-term pivotal resistance is not surpassed to the upside. Support level to watch for today, 66.35 with confluence with the 20-day moving average / 66.20 over here, this mantra. Only a breakdown below 66.20 will see a much more pronounced minor intraday pullback to retest the low of 24th of May and 30th of May at I think a support at 65.90. Only an hourly close above 67.10 will negate the intraday bearish bias view for that minor corrective pullback scenario to see a squeeze up towards 67.30 level, which is the upper limit of that symmetrical triangle range configuration that is still unfolding in the Aussie dollar. So if you look at the Aussie dollar chart, it's still going to trade within this symmetrical triangle range configuration on the medium term horizon since the low of 13th of October last year. And the upper limit of this symmetrical triangle that's been defined by the descending trend line that I drew from 3rd of February 2023 high is now confluencing at the resistance at 67.30, which I highlighted on the daily chart, on the hourly chart as well. Right. So that's for the FX market. So overall on the FX market, yesterday's strong swift dollar sell-off potentially could lead to a mean reversion dollar intraday bounce for today. All right, so that's what I mean. So now with that, let us do the short-term technical outlook on the major stock indices, starting from the Asia indices, the Japan 225. So no change on the Japan 225 using 38,290 as a short-term pivotal support level. Prices yesterday tested the 20-day moving average before moving up. So this could be the first support level to watch, 38,660. But however, as long as it didn't break below 38,290 level on the Japan 225, pardon me, which is the Nikkei 225, we will still maintain that short-term bullish bias. First resistance to watch will be this range resistance that is in place since 27th of May, 38,975. A breakout above it, that means the hourly close above it, exposes the next near-term resistance at 39,500, which confluence with the swing high area of 20th of May. Only an hourly close below 38,290 will invalidate this short-term intraday bullish bias to see the continuation of a choppy minor corrective decline scenario unfolding to retest the 30th of May swing low area at 37,750/600, which is also the 2nd of May swing low area as well. A break below it exposes the next support area at 37,105, okay, which is this congestion area here, 22nd of April and 26th of April. Hang Seng Index, which is the Hong Kong 33, no change. Price action in today's Asia opening session, which is the Hong Kong stock market open, managed to stage a nice rebound of the first support at 18,150 that we highlighted. Still no change, still using 17,895 as my short-term pivotal support. That is also short-term pivotal support level, which is also the 50% Fibo retracement of that previous rally from 19th of April to 17th of May before that corrective move took shape. So as long as this 17,895 short-term pivotal support holds, we'll still maintain that short-term intraday bullish bias on the Hong Kong 33. First resistance to watch again will be 18,570 that was rejected yesterday. A breakout above this level exposes the next near-term resistance at 18,980. Only an hourly close below 17,895 will invalidate today's intraday bullish bias to kickstart the extension of another minor corrective leg scenario to unfold. Next support level to watch 17,600, which is the minor swing low of 1st of May that confluence with the 50-day moving average. A break below it exposes the key 200-day moving average support confluencing at 17,170. European stock indices using German 30 or the German DAX as a proxy. Yesterday, price action hit the first resistance again After that, it did a pullback and retested the first support that we highlighted at 18,520 level before bouncing up. So still no change. I don't want to use the 18,520 level as a short-term pivotal support. Still using 18,405 as my short-term pivotal support level, which is so confluence with the rising 50-day moving average. So as long as this level 18,505 not surpassed to the downside, we still maintain that short-term intraday bullish bias on the German 30. First resistance to watch, okay, using yesterday's high, slightly higher, 18,680 level. All right, 680. Okay, so a break above 18,680 potentially sees the next near-term resistance at 18,845 to come in. Only hourly close below 18,405 will negate this short-term intraday bullish bias to see another round of choppy minor corrective decline to unfold. Next support level to watch 18,320, which is the former minor swing high area of 24th April. A break below it sees 18,175 next, which is the minor congestion area of 3rd of May and 6th of May. US benchmark indices, starting with the Dow Jones Industrial Average, which is the US Wall Street 30. Price action did that pullback and that bullish reversal spot on hit, survived the short-term pivotal support that we highlighted on yesterday, 38,190. So this is indeed a key level to maintain that bullish bias. So still maintain that short-term intraday bullish bias on the US Wall Street 30, i.e. Dow Jones Industrial Average. As long price didn't surpass below this level, intraday bullish bias remains intact. First resistance to watch, 38,800 for sure will be last Friday. Yesterday's minor swing high, which confluenced with the 50-day moving average, acting as a resistance as well. A break above this level exposes the next intermediate resistance zone at 38, or next near-term resistance zone at 38,970/39,130. This former congestion area over here, breakdown turns to a pullback resistance, and as well confluencing very closely to the 20-day moving average, acting as a resistance as well. So that's for the US Wall Street 30. US Nasdaq 100 much more stronger than the Wall Street 30. Why? Because prices going to trade above the 50 and the 20-day moving average. And yesterday the price did a bit of whipsaw at the 20-day moving average before bouncing up higher. So still no change. The bounce took shape right exactly above the 18,340 short-term pivotal support that we highlighted yesterday. So as long as 18,340 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the Nasdaq 100. First resistance to watch will be this zone here at 18,720/18,300 that was rejected yesterday. A break above 18,330 potentially sees the next near-term resistance coming in at 18,990/19,055. So that's for the Nasdaq 100. So net overall, we still maintain that short-term intraday bullish bias across the board for all the major stock indices that I highlighted earlier. Gold XAU/USD. Okay, so gold managed to hold above the 2,320 short-term pivotal support and managed to rise above the 50-day moving average as well yesterday. So no change, still. Okay, so we'll be flipping to a short-term bullish bias for today, because yesterday we will have that neutrality stance due to a mixed element. So given that it managed to survive again at the 50-day moving average, so using for sure the 2,320 as my short-term pivotal support level to have that short-term intraday bullish bias for today for spot gold, but XAU/USD, but it got to have a clear breakout of that 2,360 level that has been capping the boost since last Wednesday. So an hourly close above 2,360 will give more traction for that bullish bias to see an exposure to the next near-term resistance at 2,382. So this 2,382 is this minor congestion area over here of 23rd of November. And if you do the FIBO retracement, take an account of that slide from 20th of May all the way down to yesterday's intraday low, it's the 50% FIBO retracement level as well. Right, only an hourly close below 2,320 will invalidate today's intraday bullish bias to see the continuation of the corrective decline to expose the next near-term support area at 2,307, which is the minor swing low of 8th of May, and now May a break below it sees the medium-term pivotal support at 2,280, which is also confluence with the 1st of May and 3rd of May swing low area as well. And also this gray line here, which is the medium-term ascending trend line that I drew from the low of February. Okay, it's a major trend line, from a medium-term trend line from February this year. Okay, February this year. All right, so that's for Gold XAU/USD. Now moving on to WTI crude, we know that there was a nasty bearish breakdown yesterday. So with that, we will flip to a bearish bias. So the breakdown of the 7670 also hit the support level, the 7420 support level as well. So with this rather grossly oversold hourly RSI, there could be a potential bounce taking shape first before a potential round of further weakness unfold for West Texas oil. All right, so the short-term pivotal resistance to maintain to have that short-term intraday bearish bias outlook for today for sure will be 7670. We cannot have any level that's below that because this is very clearly tested 1 time, 2 time, 3 time, and this is the bearish breakdown. So what we could have over here is that potential minor pullback scenario that could unfold if I do the Fibo retracement, taken that this 1, 2, that this could be the wave 3. Okay, so that could be a wave 4 retracement taking place, which is around the 23.6% Fibo retracement, and the 50% Fibo retracement is the 76.4. So that potential minor bounce, first resistance could watch will be at 75.50 level. Okay, 75.50 level, maximum 76.60. So as long as the bounce didn't surpass 76.60 level, that's today's short-term pivotal resistance level, potentially the short-term intraday bearish bias could still hold. Next support level to watch will be at 72.60/36, followed by 71.35 level. Okay, this graphical support zone over here of 6th of February and 17th of January. All right. However, an hourly close back above 7670 will invalidate today's short-term intraday bearish bias to see another round of messy movement. Again, that means this is a failure breakdown. If we see an hourly close back above 7670, to see it potentially bouncing up with the next resistance, near-term resistance to come in at 78.95/7940, which confluence with the 20-day moving average, acting as a resistance as well. Right, so with that, that sum up the short-term technical outlook for the broad-based cross asset classes. Now, before we go, let's take a look at the economic calendar, or what are the key data to look out for today. So today calendar will be rather quiet. There's not much things to highlight for you guys. Unless there's this, the US factory orders, this is a minor economic data that shouldn't have any major impact on the movement of the market. That's 10 p.m. Singapore time. Then thereafter, we have a rather quiet US session. Bear in mind, this week there'll be no Fed speak. That means there's no federal official speaking because it's a blackout window for them due to the fact that next week will be the FOMC meeting. So in early Singapore time tomorrow, Asia session, we have 2 key Japan data to look out for that is more related to, indirectly related to consumer spending because of average cash earnings for Japan employees and overtime pay. If we start to see a number higher than expecting, because market is expecting a push up on the average cash earning year on year from 0.6 to increase to 1.7% due to the higher wage just that's been negotiated for this financial year. So any numbers that is higher than 1.7% or 2%, well, that could actually potentially see higher consumer spending down the months ahead, which will mean potentially better for the Nikkei 225 and as well for a potential stronger Japanese yen as well, given the fact that BOJ will have more chances of normalizing their decade plus of unwinding of we call it accommodating policy in Japan. Okay, so with that, that pretty much sum up for today's daily dose of market insights. I'm Kelvin here signing off. So with that, I wish you all a great day ahead and we shall speak again tomorrow. Thank you.